Hello, welcome back. This is subsection 2 of section 3, where we are going to primarily talk about Wyckoff, which, if you've seen the first subsection, you should understand already is nothing more than an explanation for structure, liquidation, and order flow in the market, but it's an easier way to begin to potentially notice it. So how does Wyckoff work? What is the snowflake rule? Why is this all important? Now, the guy himself, Wyckoff, basically traded stocks. Now, again, this is applicable to absolutely any market whatsoever. Of course, we do it on Euro USD. Other people do it on gold. I've done it on Marvel, AMD. I've done it on multiple things, okay? The thing is, Indian stock market doesn't matter. You can use Wyckoff and order flow and the ideas of order flow in absolutely any market, with the exception of like VIX, which is just ugly, right? It's just this over and over again. And even then, when you zoom in on the price action here, it will undergo the same things. It will be caught in certain order flow directions. Those order flow directions will be met with given supply and demand zones and validated ones, and those zones will be met with potential Wyckoff. So before we go further, what is the point of Wyckoff and how does it work? So a lot of you already understand that, we're going to have Wyckoff and we're going to experience it at certain areas, and usually people consider them consolidations, but let's just work from the very beginning, okay? Ultimately, this guy right here, Richard Wyckoff, great guy, amazing dude, 100 years in the working, 120 years, whatever it was, invented this idea or way of looking at price. And noticed that price will do a few things in certain areas, not even certain areas, price will undergo a few things when it's either oversold or overbought. So in smart money terms, price does become oversold and overbought. That's very normal. And at those points, big interests are going to undergo accumulation or distribution, which is going to be Wyckoff or the Wyckoff schematics, to get themselves into order. So as a lot of you already understand, we can have areas where price creates liquidity. We have liquidations of those, and you know that when this happens, we're selling into these orders, buying into them, leaving behind large demand zones that are unfilled, that have orders that are not mitigated, that are negative, billions of dollars when they're up here. So what they do is, well, the composite man will take price back into that area, mitigate those areas, right? That's why we use these areas as points of interest, mitigating those trades, and then taking them to much higher potential prices. Now, when these mitigations occur on any time frame, what's actually going on is prices delivering to you a Wyckoff schematic. And honestly, before we even talk about that, you need to recognize that Wyckoff occurs absolutely everywhere. Now, before we even get into that, because there's so much to kind of understand about Wyckoff, even though it's relatively simple, we need to understand how these areas look. So basically, the idea is, let's imagine this is normal price, right? This is an area where, again, we don't actually have indicators like this, and we're not using this, but consider like an RSI or anything of that, like you've learned before. Consider that this is completely overbought, right? So it's just so bought up that at this point, everyone should be basically selling, and this point here is very, very oversold, right? So at that point, everyone wants to be buying, right? Now, again, this is not how retail will actually think. These points are very different in terms of smart money, but just for a second, consider that this is price, and these are the areas where buying and selling is going to happen on behalf of the composite man. This is where the composite man wants to buy and sell very large orders. So what's going to happen is, you're going to have price do its thing, and as price approaches these areas here, because the composite man is fully aware of what's happening and knows that retail is most likely selling into multiple trend lines here, into multiple, resistance lines. Maybe it comes even back up here to reject some resistance, creating, double tops, liquidity, whatever it may be, dropping into these areas. What's going to happen is we're beginning to undergo potential accumulation. Now, like we said, and as you understand in section 1 and 2, ultimately, we're going to have something like this happen, right? We have structure being printed bearish, right? Potentially a shift. You have a MetaFX block, and then you have maybe a mitigation of that overall MetaFX block, an overall shift, and now all of a sudden, you know that you might want to be bullish, right? As again, most people are looking for sells, resistance, more sells, right? And as they're all selling into that, you're looking for the buys on the demand zone, entries, whatever it may be. This is creating equal tops. People are getting involved in more and more sells, right? And then you have the real mark up. And again, if you take a look at this, you'll notice that it's nothing more than structure being delivered lower, then structure shifting, giving you potential MentFX blocks in those areas, MentFX blocks, testing the areas over and over again, mitigating overall orders, and going higher. Now, what's actually happening here, as you understand from a smart money point, is that each one of these lows ultimately is engineering liquidity. And when we engineer liquidity, we're creating areas where there are going to be stop losses, there's going to be sell stops, stop losses, sell stops, stop losses, sell stops. And within that, of course, you understand if we zoomed in on this, there's more price action, which is doing the same. Stop losses, sell stops, stop losses, sell stops. So all of these areas are functioning as areas of liquidity where the composite man or institutions are going to be using to pair off their opposite side orders. So in this case, as many are selling, those orders are going to be paired off with tons of buys on behalf of the institutions. And as we get into this super overbought, I think, or oversold, it doesn't matter. You understand what I'm saying? We get to this area where composite man wants to be buying and a lot of retail or dumber money is still selling or just starting to get into sells. They will undergo what we know as accumulation, which is a series of creating certain lows, creating lows, liquidating those lows, and continuing and shifting price action, validating overall potential schematics, right? So if this was a schematic, it validates the schematic as we get above it, and we move higher. And that's when the markup happens. And as that markup happens, you already understand, we begin the partial above certain highs, looking for highs to be met, right? Running the liquidity above all these highs, because again, what's above every single one of these highs? Well, you have stop losses and buy stops. Stop losses and buy stops. Stop losses, buy stops. So they're all being paired off with orders on behalf of the buys because those areas act as profit taking on behalf of the composite man. Okay. Now, when price undergoes this little thing right here, that is what is known as Wyckoff. And Wyckoff does not just happen in areas of complete overbought and oversold. They technically do, but what's actually happening is it almost undergoes price action absolutely anywhere. Now, what I mean by that is before we even get into the labeling, understand that any area where price pretty much stops, liquidates, and continues lower, or stops, liquidates, and continues higher is Wyckoff. This is what is known as the snowflake rule. If you can find an area where this pretty much occurs on any time frame and you put a box around it, that is what is known as a Wyckoff schematic. Now again, you can go into it and label it, right? Selling climax, AR, and again, we will talk about these labels in a second. Do not worry about that. Just kind of follow along for now. ST, right? STB, and you have the SOS potentially and the markup, and you start marking up. Same thing here. You have the buying climax, the AR, the ST, the UT, the sign of weakness, maybe some kind of test here, right? And then you have the complete markdown, which is met with lower prices. If you can find any area where prices literally have highs, take out the highs, have highs, take out the highs, and put a box around it, what's happening is a form of Wyckoff. It is known as a snowflake because the way that Wyckoff is going to be delivered to you can be very substantial and very different. Why is that? Because as you all know, structure even is not as simple as this. Structure can be very dynamic. Structure will not always be delivered to you like this in a bearish run. Structure can be delivered like this in a bearish run, right? This can be full on structure and then it can shift. This itself, if you take a look at lows, the liquidation of those lows, and put a box around it, again, similarly, the snowflake rule. What's happening in an area like this is you are undergoing accumulation or distribution. You're not sure, and we'll talk about this again in a second as we work through all these subsections. But what's undergoing in these areas is there are orders being transferred from one party to another. And you always know that the composite man is the one that's going to be profitable. So you know that in this specific case, especially once we have it marked up, the composite man was transferring all the sells that were being put in by dumber money ultimately into buys on his behalf. That way he can take them higher and begin to profit at certain points of liquidity above. Which again, in the future, as we talk about risk management, is why we manage to highs. Because we understand that if there are orders that are being put in, those orders will at least run to potential equal highs, whatever it may be, because at those points there are orders that need to be transferred against each other, right? Whether it's for sells or whether it's for buys. So what's happening is, like I said, any area, again, even this little thing right here where we saw the resistance, forget about that for a second. Just look at this peak. What you're doing here is you have highs that are liquidated. Again, it's an ugly schematic, and we'll talk about that too. But if you put a box around this right there, that is Wyckoff as well. So what I mean by that is, very quickly, again, we don't want to confuse you too much with the labels and everything. Labels will be in subsection 3, but let's quickly understand this idea of the snowflake rule, which is basically saying that in any area pretty much where you have some sort of liquidation, right, and continuations, you have what we know as Wyckoff, the snowflake. And what's happening is there's a transfer of buy orders into sell orders or sell orders into buy orders based on whether you're accumulating or distributing. In a case like this where you're distributing, what you're doing is you're taking all the buy orders on behalf of dumb money, because dumb money is looking to do what? buy, as we get new highs, buys, trying to get into that. And as that happens, the composite man, right? So institutions are going to get involved and sell into every single buy. Sell. And as they do that, they will take profits where? Profit. And these lows will come to run all the lows in the past that might have been made, right, by structure, whatever it may be, and run all these lows as potential profit areas. And as they do this, they will get back in, because again, the composite man is constantly getting in and out of positions, back and forth, constantly. And as he's doing that, there are areas that he's going to run to make those profits, right? There has to be a buyer or a seller on each end for a transaction to work. And again, there's so much money that passes through this market that he's able to do this constantly and on fractal distributions and all that stuff. But what you need to understand from this specific subsection is, well, actually from both subsections, is that subsection 1, you need to understand that Wyckoff is nothing more than structure being delivered and being shifted potentially, or supply and demand zones being created by way of liquidation, by way of all that other stuff of buying and selling to go and mitigate it. Or in another sense, when you have these type of liquidations and these shifts, all you're doing is you're undergoing a potential transfer of orders in a certain market, right? And that transfer of orders can be labeled, and we'll talk about labels in a second. But the most important thing is that you need to recognize that it happens absolutely anywhere. Let's talk about exactly how. So let's go to an hourly chart. Let's actually go to one that doesn't have anything on it. This is fine. And what we'll do very quickly is we're just gonna kind of zoom out and just talk about it very nonchalantly. So let's just put a box. Let's do this. Let's have areas where we look at certain price action and understand where Wyckoff occurs. Now, what's interesting is Wyckoff doesn't have to occur once. Like for instance, this right here, right? Notice how you have lows, you have the liquidation of those lows, right? And then you have shifts in structure, and then you have this huge move up. Now, Wyckoff doesn't only occur when you have a large area like this that undergoes potential Wyckoff, right? So all this is, right? Think about what's happening here. All this is potential lows being created, price trading through, right? So bearish price action, then bullish price action, and it begins to mark up. And this is the markup. This is after it undergoes accumulation. So all these people began to sell. And all those sells were met with what? Buys on behalf of the composite man. Lots of buys were met, and those buys were taken to the promised land. Now, again, any area where you have potential literal liquidations of potential lows and anything like that is considered a Wyckoffian accumulation distribution. And this can be very confusing, and this is why many smart money people get confused with Wyckoff, because it happens everywhere, okay? Very quickly, this is an accumulation. This is a distribution. This overall thing is an accumulation, okay? This right here, with all the lows being liquidated. So again, we can zoom in. We don't have to be zoomed in, but it doesn't matter. It's all the same thing. Let's just zoom in for the sake of some of you viewing candles. You see how there's lows created, lows liquidated, lows created, lows liquidated. Then a shift, and then you have the markup. This is nothing more than accumulation, okay? This, guess what? It's ugly, but there's accumulation within there. If you want to get really interested, if you want to get really deep about it, there's lows, the liquidation of those lows, continuations. This itself is Wyckoff, okay? So again, forget about the fact that we're not labeling anything right now. All you need to understand is that you've kind of been basically dealing with Wyckoff the wrong way. Wyckoff occurs absolutely everywhere, and it's because it explains the actual movement of the market, which is the transfer of either buys to sells or sells to buys. And because there's a composite man, and because there's an institution technically that is constantly buying and selling, Wyckoff will occur absolutely everywhere and anywhere on both sides of the market. And what I mean by that is the second you zoom in, it can even change even more, right? So despite the fact that, when we zoom out, you see that there's accumulation here, but to get to this accumulation, we have to have this mini distribution. And again, even if we're on the 1 hour, zooming in on this, so again, bear with me as this gets somewhat confusing. As we zoom in on this, you have lows, you have the lows liquidated by these lows, then you have the mitigated and the markup. This itself is an accumulation. You have this, you have highs that are ran, right? Highs, those highs are ran. Price breaks down, more highs, run and liquidate them. Highs, run and liquidate them, and break down. This itself is a distribution, okay? This right here, you have lows, we run those lows. We have lows, we run some lows, then we mark up. This is an accumulation within that overall accumulation, okay? This right here, Wyckoff, okay? This right here, Wyckoff. This right here on a lower time frame, can you guess? Correct. Wyckoff. Highs, liquidated. So, again, we're not trading like this. But the point of you understanding this is very, very crucial. The fact that we consistently undergo the transfer of buys into sells and sells into buy across every single time frame is key. This right here does not look like a schematic, right? Correct, it doesn't, because it's so small. But let's go back here for a second. I don't know if this is going to work, just because I don't know how far back I can go. But let's go to 15-minute. What does it look like now? It begins to change up and start looking more like a schematic. We get to a 5-minute. Okay, we cannot go to a 5-minute. Shit, that sucks. Either way, if we went to a 5-minute on that specific time frame, there would have been Wyckoff. Let's go back to the 1 hour just for a second so we can keep working with this. Let's go find out where we were. There we are. Right, and let's keep doing this. So again, if we were this zoomed out, and again, bear with me because I know you cannot see the candles, but you don't need to see them to understand that Wyckoff happens everywhere. Okay, watch. Distribution that came to make this overall accumulation, which came to make this overall distribution after this high, right, running all the highs, that came to make, as you can see, an even bigger accumulation, which came to make much higher prices. Now, as it did that, it didn't just, these higher prices were not met as a result of all the liquidity in here that was taken out, and then we had marks up. As we had these moves up, guess what? We underwent more accumulation where? Here. This is all accumulation. As we did that and broke higher, what was this liquidation of lows? Break. Lows. Break. Lows. Break. Highs. Finally break. That's an overall accumulation as well. Now again, as we look through this, zooming in on it, snowflake rule wise, what are you seeing happen inside of here? There's a distribution here. How so? Right? Same thing. Highs liquidated, breakdown. What's inside of here? The same thing. There's highs that are liquidated, highs that are liquidated, highs that are liquidated. This is distribution. Highs liquidated, this is a distribution. Right? And this is all within that same thing. What is this? Highs liquidated. This is a distribution. Right? Highs liquidated, breakdown. This is a distribution. All of these areas are considered potential Wyckoff. This whole thing, highs liquidated. This is a distribution. You have a breakdown, but then you have a break up. Overall, it became, it became a reaccumulation. Okay? And we zoom out again, and you start to see that on a 1 hour time frame, this is everything available to you. Now again, let's come to more like recent price action. Think about what's happening here. Same thing. Overall distribution that resulted in another distribution, right? This overall thing is distribution that resulted in an overall distribution, which as you are seeing is now in line with potential MenTFX blocks, right? MenTFX block, breakdown, MenTFX block, breakdown, MenTFX block, breakdown. It's all part of the same thing. Wyckoff is structure because structure moves in a way that will deliver to you overall order flow, and within that overall order flow, there's candlestick structure, which is also part of transferring buys into sells. And as we liquidate areas and create supply and demand areas that are unmitigated, we run back to mitigate them, creating more zones of the same thing, right? Price comes down, accumulation accumulates to come here. That accumulation after that run becomes a distribution, runs lower, distributes inside of it, runs lower, accumulates where? In here, might run higher now, right? As it maybe distributes again to come lower. What will that be? A distribution, because what we're doing is we're again liquidating highs and lows, and this is only a 1 hour. We get lower, and I mean even, okay, so check this out. We even zoom in on the price action in here, and again, we have a world of price action to actually work with. This whole thing here, a distribution inside of that accumulation. This thing right here, a distribution off of the distribution, right? This thing right here, a distribution in the distribution. And again, as we're doing this, notice that it's also at the same time MenTFX block, MenTFX block, MenTFX block. Now, this might be hard to spot right now, and that's fine. That's normal. You will get used to it over time. But the first thing that you need to recognize is that Wyckoff occurs absolutely everywhere on every single time frame in every single market. This is why, first of all, I look at only one market, because I understand that this move right here can be refined 5 billion times, right? If I got inside of this to a 30-second chart, there's about 600 schematics in here. There's a schematic here, and anywhere, right? Let me just prove that to you very quickly. Let's go to most recent price action. Let's just think about what's going on like right here. This is an overall distribution currently, right? But it also could be part of an overall accumulation, because as this distributes and takes all these orders and begins to make sells down, it can be undergoing accumulation to start going higher, okay? But overall, let's consider just this area right here. That's a distribution, okay? Sure, let's say it's a distribution. We get down to a lower time frame, and all of a sudden, what do you notice about that overall area? Well, now, inside of that one schematic, right? So let's just consider this. Here's a schematic, right? So again, remember, a schematic so far, without us labeling anything, which we'll go over in the next subsection, is ultimately highs and liquidations of those highs and continuations down. That's what we're getting here. There's a schematic here. That's schematic 1, okay? Let's count the schematics we can find. Let's go to even a 15-minute and just count them inside of this 15-minute, okay? There's again, schematic where? All these are schematics, just so you know. There's schematic here, schematic 2, schematic 3, schematic 4, which distributes, okay? Schematic 5, which distributes. I'm just looking at the easy one. Schematic 5, schematic 6, sorry, which accumulates. So about six or so schematics. Okay, great, 6 schematics. We get lower, maybe a 5-minute, right? Doesn't matter what time frame we're on. Now we get inside here. What do you see? Schematic 7, distribution. Schematic 8, accumulation. Schematic 9, accumulation. Schematic 10, accumulation. Schematic 11, distribution into a schematic 12, into accumulation, so on and so forth. You can literally circle and find Wyckoff absolutely anywhere. Now, this is not how we trade. This is not going to help you too much with trading, but it will help you in understanding exactly what these markets are undergoing. Because until you understand that Wyckoff happens everywhere, you are going to continue to FOMO yourself in. You're not going to recognize that you're actually undergoing Wyckoff in all areas, and you're not going to know how to start to refine and potentially confirm it. Because that's going to all come with also section 1 and section 2. So again, what you need to do is open up any chart you want and just literally find any time that you've seen, literally go in and find any specific time where you have seen prices undergo a specific area of this. That's it. This on its own is Wyckoff. That's it. It's the creation of liquidity, right? To then liquidate it, to go higher, to come and mitigate more of it or mitigate just less of it based on how they have the mitigations. Because within here, again, you have moves that come already to mitigate and then make this high. And then maybe you don't have a move that comes all the way down. And you just need to understand that price will undergo these areas of accumulation, distribution multiple times consistently, over and over again. And again, the reason here at MetaFX we are able to trade the low time frames is because we understand this principle. And we know that within this accumulation, there's going to be 5,000 more accumulations. Within whatever price action is here, we go to a 5-second chart, right? We zoom in on it. Here, we can just zoom out. The same way we did a second ago. Don't pay attention to the actual in or price action. Pay attention to overall price. It looks the same as that higher time frame. Distribution into accumulation, into another accumulation, into an accumulation, into an overall accumulation, into an overall distribution, which gives you a little accumulation here, another accumulation here, which moves up into here, which distributes into this previous distribution, which comes lower, distributes again, breaks lower, distributes again, breaks lower into a mini accumulation, breaks higher into a distribution, breaks lower. Right, I'm just pinpointing the easy parts, but then the second you zoom in even closer, what do you start to see? Right? Within there's also a distribution here, into another distribution here, into an accumulation here, into a distribution here, into an accumulation here, into another distribution here, right? So all we're looking at is highs, 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 liquidated, breakdown, right? So that's distribution into an overall accumulation in here, right? Which is kind of this whole thing, into another accumulation in here, into what became an overall distribution in here, which became an overall accumulation right here. Okay, so this is what fractals look like. This is why smart money gets so fucking confused about everything that goes on in this market. Because the market is consistently shifting between buys and sells, because constantly there is an influx of buys and sells in the market, and the only way that you can tell exactly which way it might want to go is based on your higher time frame areas of interest, your higher time frame order flow and structure bias, and in the future, as we'll talk about even more with Wyckoff, your actual areas of expected mitigation and potential expected price action, right? So again, I mean, you can just work through any of this and go to any time frame and you'll see this. These are all areas of distribution or accumulation. If you zoom out, you can see them. Same thing, you go to a 5-minute, right? Do this with every time frame and work through it. Just understand it. The second we get to a higher time frame, that whole area of all that shit becomes a larger schematic. There's another schematic in here. It's ugly, but the second you have moves through highs and potential breakdowns. If we had a breakdown here, that would be considered a large schematic, right? Now, again, let's get rid of all this. Let's go to Euro USD. We're on gold. Doesn't matter what you're on. Doesn't matter. It happens on everything, right? But you go to a monthly chart. You think that it might happen only on the lower time frames now, but consider what's happening here, right? This is distribution. This is accumulation that became distribution. This is accumulation that became more accumulations, which became an overall what? Distribution. That became what? An accumulation, right? That became another accumulation within here. Now, again, if you don't believe that, you can zoom in and take a look at what's actually going on here, right? It's relatively simple. You're coming down with structure, creating lows. Structure maybe starts shifting, but it's playing in this area. Creates more lows. Liquidates lows here, but creates even more lows. Comes higher, creates highs, right? Creates liquidity. Comes down, liquidates all the fucking buyers, right? The real smart money gap into the most buys here, and then what? Take off to take profits where? Above highs, above highs, above highs, so on and so forth. Where do they make a run back into? That area. Why? There's unmitigated orders that they had to sell into extensively to make this move happen, right? We go to a monthly, we'll see that. Here's your shift in structure potentially, and here's your last down candle before the up move. Unmitigated price action in here. Why did this move here happen? There's no surprise about it. It's because of this. Now again, this is technically not a valid zone, but guess what? If we worked through and went back to where was it? If we worked through this price action, let's set this to the higher time frame. There we go. If we zoom in here for a second, and let's just go like this, and we actually work through finding the unmitigated portions of this price action, maybe a weekly. Let's see if we got something in here, right? You begin to see there's unmitigated what? Final down moves before the up moves that have no mitigation yet, right? You could also maybe use this area here. I don't know if this area got hit or not. We'll see in a second, but you see how you can refine that area potentially if you wanted to. Now you know exactly what this move was too. So now you can begin to partner potential overall snowflake rules, which is liquidations happening. Which is liquidation. So put a circle around it. There's liquidations happening here. Now guess what? As we get lower in time frames, what do you start seeing inside of it? You see the highs liquidated, highs liquidated. This is a distribution, right? There's another mini accumulation in here. How does it look? You get to a daily, take a look. There it is, right? You have lows manipulated, price shifts, comes a test, last areas of potential validated zones, and continues. Because price is consistently undergoing areas of moving buys into sells or sells into buys based on potential structure, section 1, MentFX block, structure 1, supply and demand zones that are formed as a result of this structure, section 2, and the mitigation of this, section 2 and section 1, and holding order flow above these supply and demand zones and within overall order flow structure, section 1 and section 2. So you can see how all of this is starting to come together. And again, we will get deeper into Wyckoff as we continue with these videos, through the subsections, so you'll get a better grasp and begin to understand it more. But what you need to realize is, even on this time frame, there's now access to even more distributions and accumulations. This is an overall distribution, right? BC, AR, ST, sign of weakness. UT, breakdown, markdown, comes attested. As it comes attested, what does it do? Gives you another distribution. As it does that, what happens in the tests of potential supply zones inside on lower time frames? Distributions. BC, AR, ST, UT, breakdown. Test, breakdown. Right? This is all part of that major one, but as we get lower, you see it fractally. These will occur absolutely everywhere. When we say that you can be a participant in the market on any time frame and you can make a system around any time frame, this is what we mean. You will have the ability to create a system that functions on any market, on any time frame, based on your own liking, because as you begin to understand how order flow in this market is created, how order flow shifts, how liquidations occur, and that they occur everywhere, you have the freedom to choose where, how, and why you want to get involved in certain trades. So again, this video, this specific one, this specific subsection, shouldn't act as you going in and saying, oh, I got it all now, I figured it out. It should act as you saying, oh, Wyckoff isn't some miracle thing that, price undergoes. Wyckoff is what every single price will undergo whenever there are higher highs, higher lows, and the shift of them. Because all it is the transfer of buys to sells and sells to buys. And what you need to do after you've taken notes on this and understood that, is go into your own charts and find areas like this. Now, again, you can partner that with subsection 3, where we will go over labels and how Wyckoff can actually look and most often looks like, because there are similarities between overall schematics, but what you also need to fully recognize as you see the similarities is that all it is, the real similarity, is that you're undergoing areas of liquidation, of liquidity creation, liquidation of those, and shifts in structure, and that shift in structure holding. And as that shift in structure holds, this schematic becomes part of new inner schematics, which becomes part of inner schematics, which inside have even smaller schematics within it, which are part of a greater move. And again, this idea right here, right there, is how I get involved in the market, which is the idea that we are constantly undergoing one or the other, and we can find multiple areas where this undergoes. Now, this video on its own should not just function as a source for you to understand that Wyckoff happens everywhere, but also as a tool for understanding that FOMO should not be a worry to you. Because if price is undergoing this constantly, and is constantly evolving and is constantly transferring buys and sells, that means that there's always going to be potential mitigation. That means that there's always going to be new schematics that unfold within schematics or potentially later on. And that means that you can always, even on a missed potential opportunity, look to get involved down the line. Okay? And then you partner with that potential with proper strict risk management, which we'll talk about in section 4 potentially. If there's a section 4, little spoiler, you have an unbeatable and defined system. So from this video, the most important thing I need you guys to understand is that anytime you really have liquidations of areas, whether it's at the lows or the highs, right, or even in between price action, remember that this does not have to be a consolidation, right? One place that looks like a just move, right, is another time frame's consolidation. So like even this big move down, inside of here are huge and beautiful distribution schematics, which we cannot see, okay? On this huge move, just this huge move up right here, first of all, you see there's a schematic in here, any lows being liquidated, right? And again, you shouldn't have to see the price action or the candles to know what's happening. If we wanted to, we could zoom in, right? And you can see it as well, right? This is very simple. You have highs, liquidated, highs, liquidated, the breakdown, that's your distribution into the lows, liquidated, into an overall, what? Accumulation. So that became one schematic, two schematic, which is an overall schematic as well. Became another schematic up here. That's a distribution. And now it's distributing, right? And as it's doing that, it could be also doing what? Accumulating. And if it did, then this would not surprise us. And what would this do? It would make a schematic in here on this time frame. And what would that do? Put a bigger schematic in here. And if that did happen, what's the weekly going to look like? The weekly, let's get rid of all this, is going to look like an even larger schematic. Because on the weekly, you might have highs, liquidated, right? Maybe you have lows, liquidated, mark up, and then you might even have a bigger distribution, right? And this would be a distribution. Price is constantly in the midst of always creating new structural lows, new structural highs, candlestick structure lows and highs, and it's doing it on every single time frame. You need to have this understanding in your arsenal. You need to understand that any potential liquidations or any little areas of mitigation of some sort are examples of Wyckoff taking place. Because Wyckoff is nothing more than, again, the transfer of buys to sells and sells to buys. Now, go to subsection 3, and let's talk about the most common ways that schematics look and how you can potentially look to mark them up. So I'll see you guys in that video.